In this video, let's talk about how to research ETFs to maximize your investment returns and wealth. Thousands of funds exist on the market, so sometimes it's very difficult to choose the right one. Today, I will share my thought process and resources I use for my ETF due diligence. The first and one of the most important things on the list are fees. According to John Bogle, the founder of the Vanguard Group, higher fees can signal lower returns. Here's John Bogle himself on this.
Get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs.
Thanks to Vanguard and John Bogle, the fund fees have been going down. According to Morningstar, over the last 20 years, the fund fees went down by 2 times, and as a result, investors saved billions of dollars. Still, there are many funds out there that charge 1% expense ratio, and according to Morningstar, Vanguard's funds charge on average about 0.07%. And even though 0.3 or 0.5% may not seem like much, it can snowball into something big. Why do fees matter? Let's take a look at this example. Suppose that you can reduce your expense ratio by 1%. Over a lifetime of saving and investing, extra 1% can extend your retirement by up to 10 years. Here's another set of fees that are hiding in plain sight, and those are trading costs from portfolio's turnover for a fund. If you go to the Morningstar website and look under the Portfolio tab, you will find this number. It is called portfolio turnover. It loosely signals the percent of holdings that a fund changed in the last year. Turning over holdings comes with a trading cost for a fund. These costs are separate from an ETF expense ratio. For a passive index fund like the S&P 500 or Nasdaq 100, portfolio turnover is usually under 20%. But for active funds or ETFs that have to replace holdings, often it could be way more. For instance, take SPMO, which is a momentum passive index fund. Given its rules, it has to trade and replace its stocks often. SPMO's turnover was 72%, and this signals that this fund probably incurs a lot of trading costs. Of course, if an expensive fund generated above average returns compared to its peers, it may not matter. Still, it's a metric that risk and cost-conscious investors should be aware of. The second key thing to focus on is the portfolio construction for a fund. The thing is that ETF's portfolio construction can tell us a lot about its future performance. Let me give you a concrete example of how I do this. Let's take an international fund called FNDF by Schwab. The first thing I start with is going to a website and reading what's available. The first thing to note is the ETFs focus on developed markets only. Schwab says that the fund uses fundamentals to weight its holdings. Now, this piques my interest. Most ETFs weight their holdings by market capitalization. Next, let's look at the fund's prospectus. Here we get more details with the underlying index for the fund. It looks like the fund uses companies' sales, cash flows, and payouts to weight its holdings. This allows the fund to take a more contrarian approach to investing. But let's find info for the underlying index. We see that the index provider gives way more details. It says that market cap weighted indices can overweight overvalued companies. Again, we see that this index uses sales, profitability, and payouts to weight its holdings, with a bit more details here. If we think about market capitalization, it fluctuates a lot, right? It could be due to some one-off event or maybe a shock that will disappear tomorrow. And while the stock price whipsaws, a company's fundamentals can be a more stable yardstick in this regard. Now, this is a bold statement. If this were true, why don't all other ETFs do that? Is there a research that gives credibility to these claims? Next, we see a footnote that mentions a research paper that this index provider used as a basis. This paper got published in a peer-reviewed financial analyst journal publication. But you don't have to be an economist to understand their gist. Let's focus on what matters. I usually read abstract, intro, and conclusion sections. There's a lot of information that you can get from that. For instance, here's their hypothesis. They say that stock prices are too noisy to measure the true value of a company. Fundamentals are the way to go. If you tell that to Warren Buffett, he would laugh and say, duh. Here's some fundamental metrics that this paper used. As we see, they are not exactly the same as what FNDF ETF uses. The paper shows that their methodology produced better returns compared to the S&P 500. Now, understanding ETFs portfolio construction can be a bit involved like this case, or it could be as simple as, say, QQQ fund that tracks the Nasdaq 100. But either way, I spent a lot of time here in reading on funds literature, because this is one of the key ways to learn how the ETF will perform in the future. What I also do sometimes, I read on Morningstar fund reports, and unfortunately those are not free. You need a subscription, which I linked down below. But sometimes it could be available through your investment brokerage. For instance, my investment broker, Interactive Brokers, give me access to Morningstar fund reports for free. All this works fine for passive index funds. But what about active funds? Unfortunately, they look like black boxes from outside. You will have to have a lot of faith in funds management. The majority of active funds underperform their benchmark for a reason. For instance, close to 90% of large-cap active funds have failed to beat the S&P 500 over the last 15 years. Many active funds face management turnover problems. For instance, if a talented manager leaves the firm, then the returns for this particular fund may revert to their mean. Or, for instance, even if a star manager is there, he may lose his touch, and therefore the stock picks may turn out to be plain wrong. Take Cathie Woods and her ARKK Active ETF. After years of massive returns, it is so beaten down that it did not even outperform Nasdaq 100. Or look at the ULTY ETF by YieldMax. Not only the fund is very expensive at 1.3% fee, but this ETF went through multiple changes in its investment strategy. It is as if YieldMax is conducting a live experiment with investors' money. Again, faith plays a big role here. Passive index funds have advantage in this regard. They have those rules that define the portfolio construction. So if something goes right or wrong, you know exactly where it's coming from. But with active funds, you may have a vague or no idea. The next thing I look at are concentrations and allocations at the portfolio level. And for that, I typically use Morningstar free resources. If you understand well the portfolio construction of a fund, there shouldn't be any major surprises. Let's take a look at FDVV ETF as a point of comparison. FDVV is a dividend ETF that tries to balance growth with yield. It gives a lot of weight to tech stocks, as we see here. Morningstar provides comparison to an average in a given category. For instance, we see that FDVV allocates almost 14% more to the tech sector compared to its peers. If we go to this weight section, we can see that its 14% allocation to growth is material. If we compare FDVV to SCHD, SCHD allocates close to nothing to growth stocks. This signals that FDVV leans more on price appreciation for its total returns. As for total returns comparison, I use the Seeking Alpha website. It's a great tool to research stocks and ETFs. I write analysis for them, like my recent comparison of SCHD versus FDVV ETFs. I partner up with them. Use my affiliate sign-up link and you will get a discount on your first year. They have this awesome charting tool. With it, you can compare total returns and other things. I use it all the time. Also, I use their dividend tab to see how the fund's yield on cost and distribution growth performed. All this can give you a lot of insight about dividend funds. Oh, and let me point out one more thing, and that's this tab for investment factors on Morningstar. Factor investing is like holding assets based on some prevailing characteristic. It could be growth, value, or momentum, among other things. I sometimes look at it to see if an ETF stayed consistent to its name. For instance, over the last 5 years, FDVV did not stray far away from its value factor. Conversely, we have the SPMO ETF. It's a momentum-based fund that I reviewed in the video linked here. Some people mistakenly think that it's a growth ETF. True, it may look like one now, but 2-3 years ago it had a heavy tilt to value. Momentum factor is the only place where it stayed consistent. Another resource that I use is the SEC website. Sometimes I want to know how a given fund looked like in the past. Let's say, for instance, I want to know how SPMO allocated funds to sectors and its top stocks, say, 2 years ago. I would go to the SEC website and input the Invesco ETF. Here we find SPMO and go for Certified Shareholder Report. This document will show all available ETFs under the Invesco umbrella. SPMO had large allocations to energy, healthcare, and consumer staple sectors. That correlates with the observation from Morningstar that SPMO is a momentum ETF, not a growth one. As for the volatility or risk-adjusted returns, I usually go for Morningstar or Portfolio Visualizer. Morningstar provides up to 10-year risk-adjusted metrics like Sharpe ratio and max drawdowns. Same with Portfolio Visualizer. The free version of Portfolio Visualizer gives risk-adjusted metrics up to 10 years. Risk-adjusted metrics and drawdowns provide an insight how a given ETF will perform under stress. When everything tanks, you'll have an idea what's coming. And volatility and drawdowns are especially important for risk-averse investors, such as those in retirement. But I want to call out one important thing. Volatility and risk are not exactly the same thing. Investment risk is a probability of a permanent loss of capital. What if a given ETF like QQQ fluctuates a lot, but it shows outsized total returns over a long haul? For someone in his prime working years and far from retirement, volatility is usually of little concern. Total returns is what really matters. That's why many young investors opt for growth funds. And that's how I research ETFs to improve my chances for higher returns. How do you research ETFs? And is there anything that you can add to my list? Let me know down below in the comments.